Wall Street, 1907. 3 weeks of financial fear. A whole country of nervous people. It looked like the whole economy was falling apart. In 1907, the United States experienced a financial crisis that became known as the Panic of 1907, and no small part of that was the Knickerbocker crisis. It started with a sharp drop in the stock market. The stock market was on a downward trend, and then, suddenly, it fell almost 50% from its peak of the year before. People and investors were taken by surprise. The banks had heavily invested in the stock market, and with the drastic drop in share values, the wealth held in banks had just plummeted. People worried the banks were broke and fearful their bank deposits would soon be gone. So they rushed to withdraw their hard-earned cash from banks as quickly as they could. The crisis began with an unsuccessful attempt to corner the market to drive up United Copper's stock price. Many believed the price of United Copper was heading down. It seemed the stock was overvalued. A big chunk of United Copper's stock belonged to the Heinze family, who naturally wanted the stock price to go up. Short sellers were betting that the price of the stock was going down. The Heinze brothers had a dislike of short sellers in general. Plus, they wanted to make some big money. They wanted United Copper price to go up, and they liked the idea of punishing those nasty short sellers. Otto Heinze and his brother Augustus correctly speculated that short sellers had borrowed many of those stocks. "Don't worry, I'm here to clear the short sellers once and for all," Otto told anyone willing to listen. He then began to buy a huge number of United Copper stock. It looked like he was trying to do a short squeeze. So, what is a short squeeze? Before we get to that, we need to know what shorting is. Short sellers borrow stocks they expect will decline in price. If the price drops, they can buy the stock back at a lower price, return the borrowed shares, and pocket the difference. A short squeeze occurs when a heavily shorted stock's price begins to rise, forcing short sellers to buy back shares to cover their positions. This buying activity can drive the price even higher, creating a feedback loop that exacerbates the price increase. Here's a step-by-step breakdown of short squeeze. 1. Short selling. Investors borrow shares of a stock they believe will decrease in value and sell them on the market. 2. Price increase. Contrary to their expectations, the stock's price starts to rise. 3. Covering shorts. To limit losses, short sellers are forced to buy back the shares at the higher price to return them to the lender. 4. Buying frenzy. This buying pressure can further drive up the stock's price, leading to more short sellers covering their positions. 5. Feedback loop. The cycle continues, with the stock price potentially skyrocketing in a short period. By buying a massive amount of United Copper shares, Otto forced the price up. He aimed to force short sellers to buy back the stock at much higher prices than they anticipated, leading to substantial losses for them. This tactic was intended not only for profit, but also to retaliate against those betting against the company's success. Otto Heinze commenced his strategy on October 14, 1907. It looked like it was working. In one day, the price went from $39 to $52, and the next day it went up again to $60. The Heinze family did not provide the short sellers with any of the family's shares, with the intention to create a shortage of shares available to the short sellers, and therefore further boost the price. This also made sure other investors lost their money if a short seller didn't have the money to buy back the shares at a higher rate. Unfortunately, Otto Heinze miscalculated the number of shares available on the market. The cornering attempt failed. He believed that the supply of United Copper stock was much smaller than it actually was. As a result, he underestimated the amount of stock that was not in his control. Short sellers had access to more shares than he realized. As much as he tried to push the price up, short sellers pushed the price down. Heinze couldn't buy enough shares to control the price. Short sellers, anticipating that the Heinze brothers' attempt might fail, continued to sell United Copper stock short. They bet that the price would eventually fall once the Heinze brothers' manipulation was exposed or ran out of steam, and they were right. This failure caused investors to lose confidence in the stability of United Copper's stock price. Panic spread quickly, and investors began selling their United Copper shares at lower prices to minimize losses, further driving down the stock price. Fearful individuals, primarily brokers, rushed through the corridors of the stock exchange, eager to sell as many stocks as possible. By the next week, United Copper stock was worth only $10, which was a loss of almost 85% of what the company was worth. The stock price may have needed slight correction downwards, but now investors were spooked and just wanted to unload their shares at any price. Ironically, after the initial rise, the short sellers that didn't panic and sell as the price rose made even more money than they had originally anticipated when the share price dropped dramatically. The United Copper price just kept going down, and that's when the real trouble started. Not only was United Copper going out of business, but the State Savings Bank of Butte, Montana, had taken United Copper shares as collateral to secure loans from the bank. This means that if the borrowers defaulted on their loans, the bank had the right to seize and sell the shares to recover the loan amount. But for the bank, these shares were now almost worthless. The inability to recoup the loan amounts due to the decreased value of the collateral contributed to the bank's eventual bankruptcy. Mercantile National Bank was the bank that did business with the New York Stock Exchange and made deals possible. Who was the director of the Mercantile National Bank? None other than Otto Heinze. Not only did Augustus have a controlling number of shares in United Copper, but he was directing the bank to participate in buying United Copper shares to drive up the price. By using bank resources to fund this speculative activity, Heinze exposed the bank to financial loss and loss of public support. By noon, October 17, 1907, Heinze walked out of the bank, having been forced to resign. His sudden resignation was meant to help restore confidence among depositors and investors who were rapidly losing faith in the financial institutions linked to him. The Knickerbocker Trust Company was a major catalyst in the panic, and its president, Charles T. Barney, was forced to resign on October 21, 1907, leading to the run on the bank the next day. The company faced severe liquidity issues as it struggled to meet the withdrawal demands. Unable to withstand the pressure, the Knickerbocker Trust Company was forced to suspend operations on October 22, 1907. This suspension further deepened the financial panic and contributed to the wider banking crisis. The failure of the Knickerbocker Trust Company was a key event in the panic of 1907. It exemplified the interconnectedness of financial institutions and how the failure of one bank could quickly lead to the failure of another bank. The bank run hit two more banks, the Trust Company of America and the Lincoln Trust Company. In the days that followed, the bank run hit 10 more banks. People had lost faith in banks, and it all started when Otto Heinze, the younger brother, attempted a big plan to corner the market on United Copper Company stock to show he could run the family business. Every story with a bad ending needs a character to save the day. In this case, the hero is none other than J.P. Morgan, who was the most powerful banker at the time. He learned about the crisis at a church gathering in Virginia. He took the train back to New York and researched all the companies affected by the bank run. J.P. Morgan organized a consortium of bankers and financial leaders to pool resources to provide the necessary liquidity to the troubled institutions. The consortium provided emergency loans and injected cash into the Trust Company of America and other affected institutions. This allowed these institutions to meet their immediate obligations and stave off collapse. Primarily, Morgan's efforts prevented bank customers from losing their deposits had the banks and trust companies failed. By stabilizing key institutions like the Trust Company of America, Morgan helped to prevent a more widespread collapse of the banking system. J.P. Morgan asked John Rockefeller and George Cortelyou, the Secretary of the Treasury, to deposit more than $35 million in various New York banks. J.P. Morgan took this action to shore up trust in the banking system. There was also a run on the stock market. Stockbrokers took sell orders and hoisted their papers in the air, trying to sell as many shares in other companies as they could. The New York Stock Exchange lost about 70% of its market value, and many brokerage companies went bankrupt. The president, Teddy Roosevelt, got involved, facilitating deals between banks and other companies. The economy suffered setbacks, but fortunately, not to the point of collapse. For the next 3 years, both production and trade rates were down and immigration stagnated. The 1907 crisis revealed the corruption and manipulative practices that were going on in the banking and financial systems in the early 1900s. Bank connections with each other and how quickly the fear spread in the market made many people wonder if there should be a new type of organization with stricter rules for banks. A few years later, this body emerged and continues to exist today, the Federal Reserve.